Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 244th VideoCast podcast for the week ending June 20th, 2024. A huge amount of stuff to cover this week, so we're going to get right down to it. First, family first, as always. The girls both celebrated their birthdays this week. Annabelle 10, Mimi 12. I believe this one was, Mimi got red velvet. This is us in Atlanta on the tail end after last week's podcast. Family photo there. Oh, this is with Chris Cannon, one of our great podcast fans, has been listening for a long time with some of his colleagues. He's over at Piedmont Jets. If you need to buy or sell a private jet, he is the guy, and was great meeting up with you for coffee. Glad you reached out. And then we've got, I think that's it for this. Okay. And then finally, there's the birthday stuff. There's Mimi's night on the 18th. There's Annabelle's night on the 17th. And this is Yahoo Finance. That's the green room for those of you who are newer. This is outside the studios on 770 Broadway. This is outside where the studio itself, where they record the TV show. So that was fun. I want to thank all three of Sydney Freed, Sarah Smith, and Alexandra Canal for having me on Yahoo Finance. Also, before we do that, I want to thank, some people like to stay private, some people like to be public, but Jeff M. and Britton for having me to lunch with a large family office on that Friday while I was in Atlanta at the Buckhead Club. Very grateful for that. Very fun lunch, and we'll get out on the links next time, Jeff, for sure. As it relates to the Yahoo clip, thanks to Sydney Freed, Sarah Smith, Alexandra Canal. I want to go into this. This gives a high-level overview in a very few minutes. Our thoughts on NVIDIA, the market, the Fed, inflation, rates, very important high levels. So we're going to listen in here.
And Evercore ISI now has the most bullish bet on the street, pushing its target to 6,000. So with signs showing inflation moderating and analysts increasingly optimistic about where stocks are heading, what should investors do next? Joining me now in studio is Tom Hayes, Great Hill Capital Chairman and Managing Member. Tom, the potential for the S&P 500 to go to 6,000. How should investors be positioning their portfolio amid a lot of this bullish optimism?
Well, Alexandra, I think that the Fed now has covered a cut, okay? You saw some weakening inflation numbers, flat month on month with the CPI, negative 0.2% with the PPI. Unemployment was up to 4%, so they can move. You're looking at the Fed funds futures with a 65% chance of a cut in September, 95% chance they're going to cut by December, and a 65% chance that they're going to do 2 cuts by December. And I think the reason that's so important, Alexandra, is that you've seen such a concentration in this rally with NVIDIA, with Microsoft, with a few others. And I think the second half, what we're seeing is those earnings are going to broaden amongst all the other companies that have kind of been left behind. And we're going to see some more participation in those laggards, which represent great value, are going to start to outperform in the second half.
So you mentioned the probability that we'll see interest rate cuts in the fall, maybe 1, maybe 2. Yeah. Given that, is now the time to load up on interest rate sensitive areas of the market like small caps, or are there other areas of the market that you're more bullish on?
I think you hit the nail on the head, Alexandra. I think you want to be in small caps. I think you want to start to look at REITs. I think the other thing that people are overlooking is that as of June 1st, so just a couple of weeks ago, the Fed is now back in the market replacing $35 billion a month of treasuries. That's $420 billion of additional liquidity for risk assets. So before, that money had to come in from private markets to absorb that $35 billion of treasuries that were rolling off. Now that $35 billion is going to get pushed into risk assets, which creates a further bid for equities into year end. And I think, again, we could see a situation where the indices remain relatively subdued, maybe up a little bit more from here, like you see some of the targets, but not overwhelmingly up. But some of the stocks under the surface, like small caps, like REITs, like some of the cyclicals that have really been left behind, anything with leverage on its balance sheet has been trading like death. The market is so scared, are they going to be able to refinance, which has a lot to do with small caps, a lot to do with cyclicals. I think once they actually see that cut or two cuts is going to happen, credit markets are going to open and you're going to see these stocks absolutely rip into year end. And that's where the exciting opportunity is.
Okay, so positive on small cap names. What about any areas of the market that you would avoid at this point?
I would avoid chasing the shiny objects. Okay, so I might be fading this split in NVIDIA. I know that's an unpopular thing. You know, the bulls will say that it's very reasonably priced because you're expecting 45% long-term growth rate, and it's trading at a 45 times multiple, which is only a one-time peg. However, you have to believe that assumption that they're going to retain 70% gross margin, that they're going to retain 45% per year growth in order to say that it's cheap at these levels. And that's simply not going to happen. I mean, one of the picks that we're going to talk about is Intel. That's received over $45 billion from the US government in terms of grants, tax subsidies, loans to create a competitive foundry to Taiwan Semiconductor. And that stock, you can't give it away at $30. And X the foundries, the legacy business alone, the PC refresh, the server refresh is worth $45 to $50 a share.
And I want to go back quickly on rate cuts because the Fed's only going to cut if we see inflation coming down. But there's a distinct difference between prices coming down and the rate of inflation coming down, which I think can confuse consumers a little bit.
Yeah.
You said in your notes that there's no way prices are going back to 2019 levels.
Yeah.
Why not?
You know, we all wish that. The only way you could get there after printing $6 trillion of money or increasing money supply by $6 trillion would be a deflationary depression like we had in 2008, 2009, where you actually have default and a contraction of money supply. What the Fed needs to see is just a slowing of the pace of price growth. And we're certainly seeing that. As a matter of fact, if you back out owner's equivalent rent and auto insurance, which finally we got a negative print, which we were all like, all the bulls are like, thank God, right? You know, we've been waiting for this forever. Now we just need to see owner's equivalent rent. You back those two out, headline inflation is at 1.83%. So they should be at the point, you know, this was kind of like a hawkish rhetoric this week that kind of threw the markets a little sideways for the stocks that are not called NVIDIA. I think we're going to start to see more of the speakers come out now that they're out of the quiet period and start to give us some expectation that even if Kashkari, who's been Mr. Hawk, saying, yeah, by December you'll get one, and then some of the more moderates coming out and saying maybe one, maybe two, we get some more data, I think that whole group of left behind stocks are going to really, really rally. And that's where the money's going to be made in the second half.
All right, awesome. Great to get your insights, Tom. Thank you so much. Tom Hayes, Great Hill Capital Chairman and Managing Member.
My pleasure.
And we're back. And then I went on Channel News Asia, which is basically the BBC of Singapore, the big station over there. Want to thank Marianne Starr Inake and Elizabeth Neo for having me on. More on NVIDIA, more on Outlook and rotation. Check it out here.
Let's bring in Thomas Hayes now, Chairman and Managing Member at Great Hill Capital. Well, Thomas, much to talk about this morning, but I want to start with NVIDIA. What's triggered its latest stock surge that really helped it vault past Microsoft and Apple to become the world's most valuable company? How much of it had to do with that 10-for-1 stock split?
I think that has a lot to do with it, Liz. Thanks for having me on. You know, there's a saying, an old saying, when everyone's thinking the same thing, someone is not thinking. Certainly the opportunity and the prospects for NVIDIA are phenomenal, but they are predicated on the company maintaining 70% gross margins. They are predicated on the idea that the company is going to grow at a long-term growth rate of 45% per year compounded, and thereby the 45 or 50 times earnings multiple is justified. And we think that this might be a little bit overdone in the short term, and a lot of this last-minute demand is attributable to the retail investors coming in at lower prices, despite the fact the value is the same. So we would be inclined to be fading this short-term strength. Long-term, great company, great execution, but I think there's going to be more competition. And you do have some government inquiries as to their kind of ecosystem and their
dominance in the field. So I wouldn't count on them maintaining those type of margins forever.
Yeah, as you talked about, Nvidia's growing sway over broader stock indices. That's kind of stoked concerns about the long-term sustainability of this market rally that we're seeing. Nvidia and a handful of those other big tech names are responsible for driving the S&P 500 to multiple fresh highs this year alone. I think 31 records this year for the S&P 500. How concerned are you about the top heaviness of the market, and what are the risks with that? Do you expect a reversal?
Yeah, I do think there is now, the last month especially, it's been pronounced. And I think that what you need to see in order for the rest of the stocks to really catch up, have some outperformance, whether it's small caps, whether it's cyclicals, whether it's any company that has any type of leverage on its balance sheet, has been trading like death. And it's simply not the case. So what needs to happen next? We need to see the Fed actually do one cut or two cuts. And I think what you're going to see once that happens, Liz, is that the outperformers like the NVIDIAs, like the Microsofts, will slow down. That doesn't mean they have to crash or anything like that at all. Underperform the second half of the year, while those laggards from the first half, because of the hawkish talk and the hawkish actions, will start to dramatically outperform, and the credit markets will open for companies to refinance, and we're going to see a rally under the surface for those companies. So like you said, with retail sales coming in a little bit weaker, we saw CPI and PPI come in weaker. I think the stage is set. Unemployment over 4%. The household survey, negative 408,000. A lot of downward revisions. We're slowing enough to justify the Fed doing that cut, which is going to broaden out the rally. As a matter of fact, today alone, Liz, Fed funds futures 69% chance of a cut in September, 95% chance of a cut by December, and a 68% chance of two cuts before the end of the year.
Yeah, and that's definitely going to give the markets more momentum. On top of that, the tech frenzy, it doesn't look like it's going to slow down anytime soon. How should investors navigate these stocks?
Yeah, I would be inclined to slow down on exposure to the concentrated tech that have led the first half of the year. I do think they're going to be more underperforming. And I do think once we get that signal from the Fed and the data that continues to confirm that they have to move before the end of the year, the opportunity is going to be in those cyclicals, in those industrials, in some of the interest rate sensitive groups like small caps, like selected REITs that have really been left for dead. And I think what you'll see is a more flat performance from the stocks that have been the hot runners in the first half, like the NVIDIAs, like the Microsoft, and a more outsized performance from those that have really lagged and gotten hurt in the last 4 weeks.
All right, Thomas, really good to have you on again. Thomas Hayes, Chairman and Managing Member at Great Hill Capital.
And we're back. So now you have the broad context and overview for this week. Let's go into the quote of the week. Most people aren't cut out for value investing because human nature shrinks from pain. I would put that, qualify that a little differently. Short-term pain or volatility for long-term outsized returns over time. And that's what we're after here. And often the greatest gains in the shortest amount of time come right after periods of acute pain like we saw in late October of last year. And then we just had this rip your face off rotation when the Fed changed its tune. I believe we're right on the cusp of that right now, where we're going to see, interestingly enough, the article of the week had NVIDIA. We talked about NVIDIA, time to get very cautious on that. And it seems to have done an outside reversal today and closed lower, although we got 20 minutes into the close. And that could set the stage for everything else to start to perform. We're going to spend a lot of time on that this week. Let's go through a number of quick economic data, and then we can get down to that. This is the Bloomberg UK GDP growth consensus forecast is bottomed in April and is now turning up abruptly. We've been talking about a recovery in UK, and playing that through GXO Logistics. So we're very excited about that. They get like half their revenue from the UK. Then mainland investments into Hong Kong and Macau surges. So the table is getting set. We're going to start to see it over the coming months in our view. We're going to talk about why. FOMO is rampant. All the analysts have been chasing up with their recommendations, and prices followed it. Have at it if you want to pay 41 times sales, i.e. pay for the next 40 times sales, not profit sales. Enjoy. And then this shows the divergence. I want to capture some of these divergences and extremes that are the theme of this week's article of the week, and how those will revert to the mean over time. Number one, we've talked about in recent weeks, the dividend payers, or in this case, the dividend aristocrats index, and the broad underperformance since November of last year till now. And this, as we get our first cut, is going to rip higher and catch the general S&P, which has been overweighted by Magnificent Seven. And you can see here the relative performance has been 20% lower than the general indices for dividend aristocrats. That is a big opportunity. Then you have transportation and warehousing services. Took a big dip in the last period here. This is why the opportunity is created in the GXO Logistics of the world. This is kind of that inflection between destocking and restocking, and then you just see it take off, kind of like the COVID lows, kind of like this spot in early 2023, and we're set to benefit. Bank of Japan to trim bond buying, keeps rates steady. This was a delay. This kind of set the market a little sideways since last week. From the standpoint of non-NVIDIA stocks, although that is changing starting today, seems pretty timely with the article. And what they basically did is they punted on another hike to July. They'll lay out their details on their bond taper plan, meaning they're going to be buying less bonds, i.e. withdrawing liquidity, while the rest of the world in a coordinated stance starts to add liquidity, namely Bank of the Fed buying $35 billion a month in bonds started on June 1st. And the Swiss National Bank surprised and not only cut once, but now today cut for a second time already. We're going to talk about an Ernest Hemingway quote in a lot of context today. It starts slowly and then all at once. And what's happening now is we're in a global coordinated easing cycle. It won't be called that until after the fact. They'll call it reducing restriction, which in effect is true, but easing is easing. You can call it whatever you want. Bank of Japan's bond buying slows to a decade low. BOJ will be tightening. Yen will go up. Dollar will go down relative to yen, and this is going to be one of the trades for those of you who trade currencies. I think long yen is the place you want to be. Industrial, same type of divergence. Any normal stock that was not named NVIDIA had this aberrational lag, particularly the last 30 days, which is just so pronounced and odd. And now that looks to be coming to an inflection point, and the game will be on. Relative performance was down 7% relative to the S&P for industrials. Equal weight, if you look at the stock market concentration just in the last short while, the top 10 stocks are 27% of the index capitalization. It hasn't been near that high since 1964. So that's a big deal. So we're more concentrated than we were in 2000. The top three stocks is 15% of the index, again, going back to 1964. And the top one stock is 6% of the index. Again, you got to go all the way back to 1963, 1964 to see anything like that concentration. TV, share of TV viewing time. This is a big deal because guess what's number one? Is Disney. Disney's getting about 5 of that 11% from streaming, 6 of the 11% from traditional TV. YouTube is not at 11%. They are at about 9% of viewing. So they're number 2. We own Disney. We own Google, albeit from much lower prices. Then you go to NBC Universal, then you go to Paramount, then you go to Warner Brothers Discovery, and finally you go down to Netflix at 7%. You can see here Disney is absolutely hockey sticked up since February. They're making some good movies, ladies and gentlemen. That woman who swam across the sea, I think that's going to have legs once it gets onto streaming. They also have, the kids went to see Inside Out, I think, or I'm not sure what it's called. It's some sequel thing they saw in 3D. They were pretty excited about. It's not Inside Out. I know what it starts with an I. Anyway, S&P equal weight index versus the S&P 500. Again, another extreme not seen since the 2009 lows. That was an opportunity of a lifetime to buy across the spectrum. We are at the exact same level. We're going to talk about today some indicators that show that while the index is trading at all-time highs, more than 90% of stocks are trading as if the market is trading at all-time lows. This is a divergence. These type of extremes are where mass amounts of money are made if you can stomach the short-term pain for the long-term gain. And we're at another inflection like we saw in the fourth quarter of 2023 before we had a monster period. U.S. retail sales. Here's what I found super exciting about this is motor vehicles and part dealers were actually up. U.S. retail sales. And when I say motor vehicle and parts, what am I referring to? Cooper Standard and Advance Auto Parts, both of which we own. Even though retail sales were down, the areas we care about were up. Here you see motor vehicles and parts were up while everything else was down. Market breadth, you can see the S&P indices up and the breadth way down. The breadth to a level that you only see during steep recessions, which is really fascinating because, again, if you'd bought this dip in 2000 when you had a pullback of breadth like this, or now in 2004, or in 2009, or in 2001, fortunes were made. We love the setup here, despite the short-term annoyance. So here is another historic divergence that's going to revert in an aggressive whipsaw rubber band way, beach ball underwater type of style, is US to ex-US. So non-US stocks versus US stocks. This is at a collapsed level not seen since 2001, which, if you recall, ladies and gentlemen, 2001 to 2007 was the greatest amount of gains in the shortest period of time in history for China, for emerging markets, for small caps, for all the things we love. Here we go, foreign holdings of U.S. financial assets. I love this picture because this is what we often refer to as sold to you. Usually when all the foreigners are buying U.S. assets hand over fist, they can't get enough. Think the Japanese buying Rockefeller Center in 1989, right at their stock market peak. And all the Americans were happy to lay off at high prices to the foreigners. The same thing is happening right now. All the foreigners can't get enough U.S. stocks. The smart people are buying the value abroad, which is at multi-decade lows if you know where to look. And the foreigners will get left holding the bag, and the smart U.S. managers will be scooping up their assets on the cheap. U.S. leasing activity starting to recover commercially, still a little bit subdued. This is not my knitting. If we get another bite at the apple, those of you who have been with us for a while knew we had a monster trade in Vornado last year and got out with the nice profits in a short amount of time. If we get another bite at that apple, we might take it for the high quality. There are going to be people, I'm telling you, if this was my game, I would be in the market buying buildings. I would be buying the highest quality I could buy at the biggest discount. So if that was B plus at 75% discounts, I would buy them. If it was A minus, I could buy it 60%, I would buy it. Would I buy B at 90% discounts? Maybe. If I had an out, like I could convert it to residential and it was pretty straightforward, which is never straightforward. Would I buy C at 95% discount? Probably not. There may never come back on that end. So your best bet, if you are a real estate investor in the next 6 to 12 months, I think if you can be buying A minus to B plus 50 to 75% off 2019, 2017 trades, I think you're going to see such gargantuan fortunes made. And if you do it without leverage or very small leverage, so you can sit through if it takes 3 years or 5 years or 9 years, I think they're going to be multi-baggers. And look, the population's only going to grow. The economy is only going to grow. I would also personally be buying in suburbs because millennials are, the largest part of the population. They're having kids. They're moving out to the suburbs. They're going to want to work in satellite offices. So I never do private deals because I think there are too many opportunities in the public markets because the public markets are way more emotional. But those are a rare area and a rare point in history where I would actually be taking an aggressive look. And I know that a lot of my clients became wealthy in real estate. So I'm speaking to you and hopefully for your benefit. And to you, you're going to say, Tom, stick to stocks. That's what we hired you for. I will do that. But I'm just telling you, I have good spidey sense in these things. All right. Retail and food sales. Okay. What is this? That is not what I wanted. Okay. Growth in labor force entirely driven by immigration. Okay. So, I don't think I need to say anything more there. Moving on, UK CPI year on year is collapsed down to 2%, which is good, which means they can remove restriction and the game can be off to the races there. And we've talked in the context of a couple holdings. Swiss National Bank policy rate, again, this was a surprise second cut in a row. Next, mega cap tech EPS growth premium is expected to narrow. This is critical. The EPS growth premium last year was 57% weighted for 5 stocks: Microsoft, Nvidia, Amazon, Google, Meta. S&P 500 median was only 4%. This year it's 37-6. Next year it goes to 19-11. Year after is 13-6. This is further support for what we're saying, that these concentrated weights are going to slow down and the under the surface fortunes are going to be made as the monies flow out of the Momo stocks and into where the puck is going next. Demographics. This is a very powerful subject. This is something that we've covered. If you look throughout history, those countries that have the largest percentage of their population from age 33 to 40, which is housing and family formation, that is when the economy and their stock market tends to grow the fastest amount, largest amount in the shortest period of time. We've pointed to the benefit related to China. You can see this updated chart right here. Their biggest amount is right around age 35. That's their kind of echo boom. Other countries that we think are going to be unbelievable. So we think that China's got one final run. Once this fat thing here goes up to here, 40 plus, the game will probably be over in China for a long time. That's why we think we have one last parabolic move, 3 to 5 year move in China. South Korea is done. You can see the fattest part is well above that. The world is looking good, but that's, concentrated. You got India, you got Africa. They're going to take some time. US is looking good. We got the fattest part here in the 30 to 34. So we probably have a little more than China. China has got 3 to 5 years to rock on. US probably has 6 to 9 years, okay, which would be really good. And India is early days because the biggest, fattest part of their group is 20 to 24. So I want to take all of those profits from China and US that we're going to make over the next 5+ years, and then just dump every penny into India. Call it, 2033. India is going to be the future. 2033 to 2040, 45 is going to be India's decade. Fortunes are going to be made there, and that's it. And Nigeria, they got a long way to go. It's going to be 30 years before they rock and roll. But this is a really helpful from Financial Times. Household net worth is rising rapidly, which should support consumption. Asset values go up. People spend money. Money market funds currently paying about $500 billion in dividends. That's 2.5% of annual consumer spending. So this goes back to the article we referenced several weeks back, which is that holding rates high may in fact be what has been inflationary, because you've got an extra $500 billion of spending capital from savers. And you've got quite a lot of savers with the baby boomers. This was updated. I think Steve Frampton, thank you for sending this to me. I hope I'm getting that right. Let me just double check. Credit where credit's due. That was from Steve Frampton. So we've referenced this China chart for a year and a half now. We didn't have an updated version. This was an updated version that he sent me from Substack. And this shows you the argument they're trying to make in the Substack article is that China's good until mid-century. I don't agree with that. I think China's great for 4 or 5 years and then they're toast. And we want to benefit from that last parabolic move like we saw in Japan in the late 80s from very similar demographics. And we're going to see from China. But you can see here, this millennials is bigger than the Gen X and the boomers. That's not Gen X. That is the boomers right there. So they got that wrong. But the data is correct. The label is wrong. Gen X is here. That was the dearth of people. That's my generation. We have the smallest generation. So millennials, as this goes from 35 to 40 is where we got our massive runaway. What they're trying to say is these alphas, which is nowhere near as big as the millennials, will just, be enough to support this. It won't. China's done after 5 years from now. So let's take the money and run, and good luck, China. So again, this is not nearly big enough to cover the deficit left behind after the millennials are done in China, which the next 5 years is going to be the biggest in the shortest period of time in history. But thank you for the updated numerical data, and we'll go from there. Consumer sentiment falls to 7-month low on worries over inflation and weaker incomes. So this is the slowing that the Fed needs for cover, as we covered in the Yahoo appearance. The U.S. needs to build 2 million houses to revive the American dream of home ownership. Can and will. They'll build smaller houses. They'll build them at large scale the minute you see a cut. There are so many projects on hold when I speak to developers. Some have given up and just said, okay, rates are never coming down. We're going to just start building anyway. But for the most part, they need confirmation. And once that happens, you're going to see, think Levittown, 1,000 and 2,000 square foot starter homes. Everywhere there's dirt, it's going to be like crazy. And guess who's going to benefit? Literally the pick and shovel sellers, aka Generac. Every house is going to have a generator. Stanley Black & Decker. If you're going to build a house, you need DeWalt, you need Stanley, you need Craftsman, you need Black & Decker. You need it. We got it. It's going to rock and roll. Destock to restock cycle is here, ladies and gentlemen. Yen, Japanese bond yields fall on Bank of Japan stalling tactic. That was a dumb move, but they're in a box. They'll do it in July. Chinese tech stars Alibaba, JD Fuel, convertible bond surge, likely precursor to IPO rush. So animal spirits are starting to come back in Hong Kong and China. Here's an article from Motley Fool. Prediction: artificial intelligence leader NVIDIA is going to... Oh, that's pretty aggressive. I don't agree with that. And this is not the article I was intending to put up. Okay, where is the article I was intending to put up? I guess we'll get to it. Basically, the article was like, by Amazon and Intel instead, which we agree with, and we own both of those. Alibaba Health resumed with a buy at Goldman Sachs. What is Alibaba Health? We own, as owners of Alibaba, we own, I think, 57% of Alibaba Health. This is just one more of those highly valuable, fast-growing businesses that we own that zero credit is ascribed to until the stock price gets back to 200, and then analysts have to justify how the stock price got so high, and they actually start to do the work, and they realize what is owned under the hood and how owning Alibaba is the cheapest AI play in the world and a proxy for an AI ETF in China, because they allocate compute credits from their cloud division to AI startups in exchange for equity, which is the most brilliant trade that we could ever imagine in a nascent industry in what will be a parabolically growing market for the next 3 to 5 years. China May retail sales beat expectations, so that was a step in the right direction. Bryson DeChambeau wins another U.S. Open with a clutch finish to deny Rory McIlroy. Look, love him or hate him, I like Bryson because he keeps grinding and he keeps looking for solutions. He actually cut his teeth with a book called The Golfing Machine by Homer Kelly, which was taken up by Mac O'Grady. Some of the older listeners will know Mac was one of the best ball strikers of all time, couldn't putt worth a you-know-what. Similar to Ben Hogan, by the way, putting almost took him out of the business. Ben Hogan always thought it should be two separate games. One is hitting the ball and one is putting. But Mac O'Grady took the Homer Simpson stuff, and then you had kind of the next phase was Stack and Tilt, which was my buddy Mike Bennett and Andy Plummer, and of course my friend Gene Mulak, who taught me how to hit the ball. And it's been phenomenal. Had an not unbelievable. I had a great round yesterday. Why? Because I was willing to look stupid and be different, like Bryson DeChambeau with my stupid, lab broomstick, which is I call my desperation stick. And all that changed was I eliminated 3 putts. I've been hitting the ball great. I missed 8 birdie looks within 15 feet, but I only had 1 3-putt, 41 on the front, 43 on the back with a triple on 18. And that was just an unfortunate thing. It wasn't putting. I came out of the trap hot and into this super deep, 6-inch rough where you have to kind of toe pick it out, and it didn't toe pick out. But it doesn't matter because I wouldn't have broke 80 anyway. I would have gotten close, so I didn't lose sleep. The key is I really admire this guy because he's willing to do whatever it takes, and he doesn't worry about what other people think. He's an independent thinker. Everyone wanted to poo-poo him, and he got the job done. So for all the others that were focused on looking good, they went home with their tail in their legs. And for those that were willing to be different and think outside the box, even if no one liked it, he got the job done. So lesson in life. More solid inflation data opens the path to rate cuts, Fed President Goolsbee says. Every time he talks, I smile. Mohamed El-Arian, this may be the first time in history I agree with what he's saying. And what he says is the Fed needs to cut interest rates sooner rather than later. We couldn't agree more. His emphasizing that the Fed could tip the U.S. into a recession if it waits too long to cut rates. The flip side to that negative view is if they cut early enough, they may only have to do 1 to 2 cuts. It could be very mid-cycle like 1995 and be more than enough to then open the credit markets, get everyone to refinance, and rock and roll another 5, 6, 7, 8 years. The demographics certainly support that view. Hong Kong may reap bonanza as Chinese expedites approvals for offshore IPOs. Hong Kong stocks jump on hopes for market boosting policies. Remember, we talked about that big meeting coming up in July. Here's the article I wanted to talk about before. 2 artificial AI stocks to buy instead of NVIDIA. They reference Intel building $100 billion in chip manufacturing plants throughout the U.S. No one is going to be able to compete with this, ladies and gentlemen. Go back to the article last week where I laid it out. on hedgefundtips.com. Oh, and by the way, while you're there, click on terms. This is all opinion, not advice. We don't know your financial situation. We deal exclusively with accredited investors, qualified institutions, family offices, and the like. There's terms. This is hedgefundtips.com. By the way, if you're not getting our daily reads, every day we put out all the articles that we're reading. You can just enter your email address here, scroll down on hedgefundtips.com, first name, email address, remove yourself anytime, and you'll get those daily reads every day, save you a lot of time, give you the best stuff out there. And they're talking about Intel as the better AI play and Amazon, both of which we own and both of which we agree. Is this Amazon's next $100 billion opportunity? They're talking about the logistics business in the United States. We agree. Lots of upside. And finally, here, America's card box recession is finally over. Bank of America says, meaning e-commerce is picking back up, meaning what we've been talking about. Goods went crazy during COVID when everyone was locked down with nothing to do. Then they got out. Revenge travel services spending went crazy. That was a key part of inflation that kept inflation sticky for a while. Now what's happening? Balance, baby, balance. Demand for goods is now normalizing and balancing with services. What does that mean? Restock cycle for the Intel AI PCs, which are going to exceed their expectations for 40 million AI PCs this year alone. Stanley Black & Decker gone through all the tools. Now they're going to reorder with the construction boom and all the Inflation Reduction Act construction spending and the reshoring, et cetera, et cetera, et cetera. And logistics, GXO Logistics they get paid per unit. This was why they were down, because everything went to an extreme from goods to services. Now it's normalizing. They're going to hockey stick back up and the game is going to be back on. There's a method to our madness, ladies and gentlemen, believe it or not. Those of you who have been around long enough, you know that there's a method to the madness. In the short term, it's like, what the hell is he thinking? And then you wait 6 months, still doesn't happen. Oh man, he's early. And then 12 months and 18 months, you're like, oh my God, wow. When it happens all at once. Undervalued stock could join NVIDIA in the $3 trillion club. They're referencing Alphabet. We agree. We own it. EU imposes sanctions on Russian LNG. Thank you, EU. Comstock loves you for doing that. The U.S. energy producers, thank you very much. We own Comstock. U.S. initial jobless claims lingered near 10-month high last week. This is the cover the Fed needs to do that cut. It looks like September. We talked about some of the statistics. They move around. But last I checked, it's like 65% chance of September, 95% chance of December, 65% chance of 2 cuts by December. It might be up to 70 today. I have no idea. Inside Citigroup's most mysterious business, they basically have a moat. They've been doing meetings to actually help people understand how valuable their business is with liquidity management and payments, trade finance, security services. They serve 5,000 of the world's largest multinational companies and investment managers. They used to just refer to this as the pipes business. No one else has an international system along these lines. And that moat, as the game gets back on, is going to take it to even higher levels, even if it rests in the short term, in addition to the resurgence of M&A and IPO cycle coming back probably in the second half of this year once you get the first cut and animal spirits beyond NVIDIA come back. Moving on, we've got this indicator suggests unloved small cap stocks may be poised for a turnaround. We love that, similar to 2001 to 2007 again, which we've referenced multiple times, and the setups are looking exactly the same. This is talking about a level of excessive outflows that precedes massive rebounds. We agree. Sellers are entering the market with S&P faltering beyond tech. So what Jessica Menton is talking about here is the breadth. S&P breadth remains well off the November peak. And more securities hitting 52-week lows on the NASDAQ. And this is what I'm saying, that never have we seen a situation where the indices were trading at all-time highs and the majority of stocks were trading like the market was at lows, and that creates the divergence and the opportunity and the catch-up. Here's an analyst who has been bearish on China stocks for ages. He just flipped the switch. JP Morgan analyst known for bearish call touts China tech stocks, and basically he's saying earnings are going up. I mean, you can't have fundamentals that continue to go up like this. and not have good things happen. And we couldn't agree more. As you can see here, it's just been grinding sideways for a year and a half and put in this reverse head and shoulders bottom. Interestingly enough, this Hang Seng Tech Index looks exactly like Alibaba, by the way, and 10-cent charts. And he's finally turned the corner. So that's positive. All right, the article of the week, the next pain trade, stock market, and sentiment results. So here's NVIDIA signing a fan's shirt, which, you know, I mean, when you have this level of fan enthusiasm for a CEO, you know, we've seen it before. It usually doesn't end well. So NVIDIA has been all the rage, and justifiably so. Since NVIDIA reported its Q1 2023 earnings report and disclosed the huge demand for its AI chips, the stock has gone straight up. Now it's worth $3.3 trillion. Revenue's up 4x, margin expansion, everything anyone could ever wish for. As the stock went up, bulls exclaimed, "It's getting cheaper." Because earnings grew, the multiple came down. But now we have a different landscape, one of decelerating growth. Quarterly revenue growth has gone from 88% to 34% to 18% and on its way to single digits. Now the multiple is reaccelerating into slowing growth. Next quarter revenue growth guidance is just 7%. All of the marginal buyers are in, sucking in the last few retail buyers with the lure of a stock split. History suggests a short-term bump after a split, as we are seeing, but now institutional investors have a vast pool to distribute their shares in coming months. As the saying goes, when the ducks are quacking, feed them. If the quarterly revenue growth continues to moderate, earnings growth will be impacted as well, making the stock become more and more expensive as the multiple screams higher, versus the theme of last year when the higher it climbed, the cheaper it got. This does not change the fact that it is a great business with a great leader, which will play a role in the advance of AI technologies and productivity. It's just going to be a heavy lift for it to retain a perception of greater value than Amazon, greater value than Microsoft, or greater value than the entire German stock market capitalization combined. This is where it trades right now. NVIDIA is still a semiconductor company, which has never been a secular business. Every cycle, people say this time it's different, and always and invariably, it is cyclical. Always has been, always will be. As for 70% plus gross margins, as Bezos famously said, your margin is my opportunity. NVIDIA has not cured cancer, despite common consensus that somehow it has. There will be more and more competition going forward. For instance, Intel's Gaudi 3 is 50% faster than NVIDIA's H100 and 40% more energy efficient. AMD is gunning for them. The game is just beginning, and NVIDIA will be forced to share the pie, as no buyer wants to be beholden to one company. NVIDIA is a great company and will continue to innovate. We are in an AI productivity revolution. I would never bet against it. However, price is what you pay. Value is what you get. Caveat emptor at these levels. You want to pay them for 43 years of future sales when they're decelerating the rate at which they grow? Have at it. Sold to you. What may go even higher in the short term can go a lot lower in a blink. The table is set, ladies and gentlemen. When distribution to the great unwashed begins, keep in mind the wise words of Ernest Hemingway. It occurs first very slowly, then all at once. Yahoo Finance, we covered our notes there. We didn't get to talk about GXO on that call. We've talked about it in previous podcasts, so you can just read the notes there. Intel, we talked about a little bit, and you might want to read these notes because they weren't able to be covered all in the 5-minute segment. 5-year inflation break-even rate is now back to 2018 levels. Expectations 5 years out are 2.17%. That is lower than the bulk of the period between 2004 and 2007, and pari passu with 2018, 2013, 2011, and 2010. Data on small caps, least expensive versus history on half of the metrics. You see here, not as cheap, this cheap since 2001. We go back to that magic period, 2001 to 2007. All the stars are lining, ladies and gentlemen. Small caps, emerging markets, same as equal weight relative to the S&P. Hasn't been this pronounced since the lows in 2009. If you bought the basket then, you made a killing. Bank of America shows the breath level deteriorating, and that creates the opportunity. Ryan Dietrich put out this chart. Can the Fed really cut with stocks at all-time highs? That's been a common question. They've done it 20 times since 1980, and the S&P was higher a year later, 20 times. Moving along, the retail sales data that supported what I said on CNA with Elizabeth Neo shows that all these groups weakening on balance. Retail sales were weaker than expected. However, auto parts and autos were up. Second half earnings, as we talk about broadening out, what you see is a move from the Magnificent Seven earnings to the ex-Magnificent Seven. So you had 28% earnings growth in the first quarter for Mag 7 versus 6. That goes up to 7, goes up to 19 by the fourth quarter, which will be greater than the Magnificent 7. Market will start to discount that maybe starting today. Yahoo Finance, that was from Yahoo Finance. Manufacturing Survey Tracker and ISM Manufacturing. This is a beautiful setup, ladies and gentlemen. We see that manufacturing has bottomed. It's been in a recession for 2 years, which we've talked about many times. And it's turning up just like it did in 2016 after the 2015 and 16 corrections, and just like it did in 2012 after the emerging market debt crisis, and just like it did in 2009. This is going to lead to all of the other companies that are beneficiaries of AI gaining efficiency, like GXO Logistics, for instance, and others now sharing the benefits and the fruits of the labor as the arms dealers become commoditized. Some market observations, as I stated in my 2 appearances above, we are on the cusp of a broad participation explosion. Sounds like a new Taco Bell offering, where the shiny object leaders begin to underperform while the laggard remaining 90+% of the market can begin to outperform. All that means in English is that the general indices may begin to flatten out, more modest net growth into year end because the heaviest weightings begin to slow while the lower weighted issues begin to take off. 5 stocks account for 60% of the S&P 500 return year to date, which were Nvidia, Microsoft, Google we own, Meta, Apple, and Amazon we own. These laggards are going to be where you're going to see some of the big gains into year end. Intel is in there. Boeing we've recently bought in there. Intel we bought in the high 20s and low 30s to build back out the position that we bought at 25 and sold at 48 last year. Rebought now at 29 to 31. Lulu, we're keeping an eye on. I know you all keep bringing that up. Looking at new highs, new lows index, and have done nothing on Lulu, by the way. For the NASDAQ, we can see just how pronounced the effect of a few stocks has been on the general index. Am I getting this point across, ladies and gentlemen? Due to their weightings. Drops like this have been coincident with lows in the index, not new highs, meaning the vast majority of stocks are trading like the index is at lows, not highs. That's where your opportunity is, ladies and gentlemen, and that's what we're talking about here. Let's look at sector by sector relative performance versus the S&P. All you need to see is every single one is pointing down except for IT, which is basically Microsoft and Nvidia that has taken it to these elevated levels. Consumer discretionary, train wreck. Financials down, industrials down, energy, materials, real estate. Effectively, if you owned anything other than Nvidia. And then you could say, well, Tom, then why didn't you own Nvidia? people hire me because I don't own the things like NVIDIA. And the reason is because over time, when you can consistently find doubles and triples that can be a double or a multi-bagger over a period of years, and you can do it with regularity and predictability without predicting the future with a crystal ball of what the next great technology is going to be, you're going to compound money consistently over time. You'll always have short-term volatility, but in the long term, you will multiply your capital. Whereas if you're predicting the next great thing, yeah, they'll write books about the guy who buys Tesla at $6 and takes it up to $400, but they won't write the books about all the other folks that buy Dogecoin or the other ridiculous things that have no intrinsic value, or companies that blow up like Solyndra, etc., and get completely wiped out. You wind up with survivorship bias when you're predicting the future. 1 in 1,000 gets it right, 999 go broke, and the one that gets it right, because they don't know how they got rich, because they actually did it more by luck than skill. It was an accident. They happened to predict, they happened to buy the story, and the story happened to be right, even though there were 999 empty bag stories similar to that story, is that the ones that even make it big in the lucky guesses wind up giving it back to the casino because they have no predictable, repeatable framework. And the sadder part is the people who chase those people who got short-term gains by luck versus skill, and then they give it all back to the casino. It's about a proven, repeatable, consistent framework that works over and over time. And that's what we're after here. And hope you're getting some value, us imparting some of our experience and information over time. Consumer staples, same thing. Healthcare, communication services, utilities, energy, transportation. I don't need to reemphasize that. That's all you need to do is look at the pictures. And by the way, if you're listening, I know everyone loves to walk and ride bikes and play golf while they listen to the podcast, and that's great. Some of these visuals, ladies and gentlemen, it will give you 3 times the value from listening. So maybe you can do a Peloton and watch it while you exercise in that regard. Just a suggestion. Everything works. That's why we have it in both forms. And then the extreme that we talked about, 3 standard deviations above the mean of S&P 500 to ex-US. This is going to be the most violent reversal that we've ever seen in terms of relative performance, and it's coming to a theater near you. And when's the last time it was even closer to this? 1.5 standard deviations outside the norm was 2001, ladies and gentlemen. And then all of a sudden, international outperformed domestic. That doesn't mean domestic's crashing. It just means we're going to see rip-roaring action in emerging markets and ex-US, in our humble opinion. Nothing is guaranteed. We just take probabilistic viewpoints based on data, and we do it consistently over time. Here are top 10 stocks are pricey. The rest aren't too bad. So if you look at the top 10, they are at their 138% of their average multiple. You look at the weight of the top 10 stocks. Again, same story we've been covering. Now, this is exciting, ladies and gentlemen. If you remember, we were in a similar situation in October 2023 until the switch flipped, and the next 2 months was the greatest rally in the shortest period of time for laggards that we had seen in years. By January 1st, we were smiling so wide we could eat a banana sideways. Notice the resemblance. Here is the NASDAQ advanced minus decline issues, and you can see how pronounced it was in late October. All of the things were down: small caps, Intel, CPS, Stanley Black & Decker, Generac, PayPal, Citi, XBI, Biotech, Crown Castle, Generac, GXO Logistics. GXO, I don't think we owned back then. Small banks, 3M, emerging markets, VF Corp, Baxter, et cetera, et cetera. Same companies, same fundamentals. And then what happened is the switch flipped and you got broadening, and these things ripped I mean, some of these were up 50 and 100% in weeks. It was mind-boggling. And I think we're at a similar inflection here. You can see the NASDAQ advanced minus decline issues. We're closed to $1 million accounts. We'll reopen again in Q2, which is right around the corner. So if you're interested, get your ducks in a row. For the 5 million plus, if I'm in your shoes and I'm thinking about doing 5 million, I'm doing it now because it's bespoke service. But that's just me. You look at the data and you decide for yourself. The million, we'll do it sometime in the next 5 or 6 weeks, and we'll do it all at once. Same companies, same fundamentals. The difference is structural shift based on perceived shift in Fed policy and the cost of capital moving forward. Keep in mind, they are no longer in a blackout period, which means you're going to see a lot of lips flapping from the Fed in coming weeks. And all it takes is the right lips flapping the right words, and everything changes overnight. So, structural shift based on perceived shift in Fed policy and cost of capital moving forward, i.e. a Fed removing some restriction will yield a soft landing and capital markets open for refinancing for companies with debt, as we referenced with Alexandra. Companies that have any leverage on their balance sheet are trading like death. The rumors of my, the old saying, the rumors of my demise have been greatly exaggerated. That is the case with some of these unbelievable multi-decade, some companies around 100+ years that are going to be just fine. In my appearances above, I laid out the case on why the Fed will move before year end and the impact of the Fed buying $35 billion a month in treasuries that resumed on June 1st, 2024. Do I expect any miracles before the end of Q2? No. However, the shift could begin very soon once again. We are at a meaningful extreme. NVIDIA should rest and everything else can rip. CEO confidence has rebounded back above 50. That's not things you see at the top. That's things you see coming out of lows, which, by the way, the entire market, X these few stocks, is trading like the market is at lows, not highs. And these are when you see this confidence recover, it's the beginning of cycles, not the end. And we're just seeing it get over this median line like you did in 91, like you did in 2001, like you did in 2010, and like you did right out of COVID. This is a good thing, not a bad thing. Tech Rec Part 2. I never took French. Anyway, valuation of largest stocks today is below the .com peak. That's the 10 largest stock trading at 30 times. Regular stocks 18 times. So for everyone comparing the current market to the 2000 tech wreck, you are blinded by recency bias. It will not repeat in the exact same way or even potentially at all. Each new downturn has a new flavor. However, in 2000, the NASDAQ tech wreck did in fact repeat 2 years ago in China. Here's how it looked. Over the 2 years from 1999 to 2001, the quote, Alibaba of the US, top e-commerce company and would-be cloud provider Amazon.com, fell 95% in stock price despite the underlying fundamentals improving under the surface. Over the next 2 years, from late 2001 to 2003, the stock recovered most of its losses. It's gone on to be a 60-plus bagger since the 2003 recovery. That's not off the lows. That's after it recovered its losses. It went up another 60x, meaning if you had bought it after it recovered most of its losses, a million became 60 million. So listen to what Jeff Bezos had to say about this period, which is similar to what is happening at Alibaba right now. What do I mean? Price down massively, fundamentals still improving, free cash flow still improving, everything moving in the right direction. This 1 minute that I'm going to play for you right now is more important than the last 244 hours that I have given you on this podcast over the last 5 years. If you understand this and internalize what he's doing and learn how to analyze businesses from this perspective, like we try to do every single week, you will make wealth beyond your wildest expectations over time, if you're willing to do the work and internalize these concepts, which doesn't happen overnight. So listen to Jeff Bezos.
Stock at one point, I think, went to $100, but then it went down to $6 or something like that.
At the peak of the internet bubble, our stock peaked somewhere around $113.
Okay.
And then after the internet bubble, busted open, our stock went down to 6. It went from 113 to 6 in less than a year. My annual shareholder that year starts with a one-word sentence, and that one-word sentence is the word ouch.
So most of those internet companies of the dot-com era are out of business.
Yeah.
You survived. What was it that made you to survive, and virtually the rest of them are gone?
That whole period is very interesting because the stock is not the company, and the company is not the stock. And so as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics, number of customers, profit per unit, everything you can imagine, defects, etc. Every single thing about the business was getting better and fast. And so as the stock price was going the wrong way, everything inside the company was going the right way. And we didn't need to go back to the capital markets. We didn't need more money. The only reason, a financial bust like the internet bubble bursting makes it really hard to raise money. But, we already had the money we needed. So we just needed to continue to progress.
And we're back. So here's the Amazon chart, down 95% from 2000 to 2001, late 2001, then up 10x from the lows by 2004. So it took about 3 years. Over 2 years from 2021 to 2023, the Amazon of China, top e-commerce company and cloud provider Alibaba, fell 83% in stock price despite the underlying fundamentals improving under the service. Over the next few years, we'll see how it can recover. Will the first 1 to 2 cuts cause a catch-up play in emerging markets, China, in the second half of this year? Time will tell, but the underlying fundamentals continue to improve. As a matter of fact, it's funny. I was talking to a buddy of mine. We were playing golf, and I was telling him, I might be going to China in August for my kids to swim. I'm going to go see management of Alibaba. I've been in this position a year and a half. It's done nothing. And he's like, well, what are you going to tell them? Every single stock is down in China, and when they go back up, so will Alibaba. And I was like, you may have saved me 30 grand on a trip. So anyway, well, so that's that. Here you got David Tepper, we've covered. He's got $814 million of his own money in Alibaba. It's his number one position as of Q1, new position. David Tepper may struggle a bit in picking football players, but when it comes to picking stocks and turnaround situations, few are better. Retail sales starting to turn the corner. Bank of America Fund Manager Survey. On Tuesday, we put out a summary of the monthly Bank of America Global Fund Manager Survey. This month, they surveyed 206 managers with $640 billion in AUM. You can find it here. Recoveries, here were the key points. Recoveries in corporate profit growth expectations off of depressed levels precede multi-year recoveries, just like they did in 2020, just like they did in 2009, just like they did in 2001. There's that 2001 year again, all over. Overweight tech crowding starting to weaken, minus a couple of select issues. What's happening? Institutions can distribute now that all the ducks are quacking. REITs are starting to get a little love, but dramatically underweight relative to history. You can see a little bit move, and then you can see the absolute relative to the 20-year exposure and the different opportunities there. Emerging markets relative to 20 years, still underweight. REITs underweight, energy underweight, etc. UK underweight. What is everyone overweight? Bonds, telecoms, that makes zero sense, etc. All right, percent that say they're overweight. Real estate, again, current allocation is 1.8 standard deviation below its long-term average. Waiting for the whipsaw reversal in the two most crowded trades. What are the most crowded trades in the world? Long Magnificent 7 and short China equities. These are going to rip reverse and catch a lot of people off guard. In short, if you enjoyed the last few months of 2023 and early 2024, what's ahead will make those gains look like child's play. Those with money to work in the right places now are going to benefit from the residual effect of an opportunity created by a once-in-a-100-year event, destock/restock cycle created by COVID. It's just the beginning. Here's all the cash that has availability to go to work. Fear and greed, a little bit of fear back in the market despite all-time highs. It tells you everything you need to know what's going on under the surface. National Association of Active Investment Managers. We covered this. Opinion, not advice, not a solicitation. June fund manager survey you can go through on your own. There was some insider buying in GXO Logistics this week. $500,000 purchased by one of the chief executive officer wrote a check. That's good to see. And then VF Corp we covered last week. Bracken Darrell pulled $1 million out of his checkbook and bought. Oh, excuse me. We got someone else that pulled it. Bought some stock here. Looks like about $300,000 of stock bought by a director after Bracken bought $1 million. So that's good. Doesn't look like a company that's going bankrupt tomorrow if they're writing checks out of their own pocketbook. IBD Growth Index, top 30 weights. This is the growth index. The earnings power of these was revised up 11% in the last 60 days. And for next year, up 9% in the last 60 days. Does not look like a hard landing to me. Materials, on the other hand, was revised down just under 1% for this year and just at 13 basis points down for next year. Key economic numbers this week, we kind of covered them. Retail sales, initial jobless claims came in higher than expected again. So we're seeing that weakness in the employment market, which is good for the dual mandate of maximum inflation, which gives them cover to cut. Switzerland already got the message and they did 2 cuts and will be soon. Earnings hanging in there at 245 and 280. No change there. That's good news. Been going upright in the last handful of weeks. And now the podcast is over. Those of you who'd like to stick around for the Ask Me Anything questions, we're going to cover that now. This is the bonus round for extra credit. From our first listener, Will Kuharski says, Tom, I really enjoyed the pain trade commentary you wrote on June 20th. Will you be doing those type of posts more often with all the details? We do them every single week. If you don't get them, just go to hedgefundtips.com, scroll down here, put in your first name and last name. Now, if you're referring to, Tom, you did a bearish piece, I like bearish stuff, good luck with that. The greatest bear of all time, quote unquote, short seller, blew up his fund and had to shut down and has been accused of misappropriating funds. So, what's the old song, I fought the law and the law won? Well, this guy should have a song, I fought the Fed and the Fed won. I would not be enthusiastic, and I don't even like doing any bearish things. But when I see unbelievable extremes, if I don't keep it to myself, I will talk about it. The reason I felt so good about talking about it is because we published it this morning and we had no positions, long or short, in NVIDIA, just an observation. I would never short an individual company and be public about that. It's just bad policy and it's not my style. Here's a guy from CV Dai, from a listener from the Philippines. Thank you for all the good work. Would you look at D&L Industries? I think this is a Philippine company. I think the Philippine has really good demographics, actually. So I should probably be spending a little more time. D&L. Let's see if it even comes up. Okay, cash flow. All right, so it looks like it's recovering. Revenues are a little bit soft. What do they do? Provides food ingredients, aerosol products in the Philippines. All right, let's get some financial analysis here. All right, revenues have started declining. So first thing you need to figure out is why have the revenues fallen pretty precipitously between 2002 and 2000 and now, and what is management's plan to get them back? Is it a cyclical business? I don't see that level of deterioration at any time in their history. Did they sell a division? What's going on there? The balance sheet looks fine. Cash flow is recovering. Business historically is decent. So I think it's worth starting to do the work. You got to read the annual reports, listening to 8 or 9 conference calls, get a feel for the business. Has management delivered on what they said they were going to deliver historically? Why or why not? But the stock is down only 40% after a drop like that. There are higher and better uses, in my opinion, but I think it's definitely worth a look. So nice find, and probably okay there, but you got to know the business. Christopher Wallace, great education and information on your podcast. Thank you for this content. STLA seems positively cheap to me and is growing cash, increasing capital it returns to shareholders. The stock does not seem to know this. What am I missing? You're probably not missing anything. Go re-listen to the Jeff Bezos tape. It's just what the market does in the short term. It's a voting machine based on emotion, and in the long term, it's a weighing machine based on fundamentals. So let's take a look at STLA, and then we can move forward here. STLA. Yeah, I don't think Stellantis has fallen enough, to be honest with you. I mean, yes, the revenues are up. Yes, it's cheap. Look, GM has been cheap for like 30 years. I don't like that business because you got union employment. I'd rather just own an arms dealer like CPS and let these guys duke it out as inventories build and they got to cut prices, which increases volume for us. Yeah, it's cheap. So is Ford. So is GM. But I don't want to play in that game. I'm playing specifically the way that I'm playing for a specific reason. David Sorstad. Let me just see. I'll just take a closer look at Stellantis. But you're not going to get as much leverage playing Stellantis as you would the way that we're playing it with Cooper Standard. Yeah. I mean, look, GM has been cheap for forever. It's basically done nothing in 10 plus years. Ford, same thing. Maybe they all take off at once, but the minute they take off, you're going to have that guy on TV pounding the table and Mary Barra giving him all the money he wants with the UAW. So it's just, I don't want it. I don't want it. Anything that has union employees, not interested. Or the bulk of union and hostile union employees. Some manufacturing companies have a small union and they never give them a hard time. They just want their people to have jobs. It's good. David Sorstad, Tom, my guy, you've mentioned a few times that you see the Canadian dollar strengthening. I'm assuming more of a long-term perspective. Can't help but notice Canadians weakening employment productivity, obvious interest rate cuts far before the U.S. Cheers from Alberta. Yeah, we've covered it. Just look at commercial positioning in the commitments of traders. Smart, dumb money is getting short. Hedge funds, large traders, commercials are getting long. It always precedes a run up. So yeah. So David, you can listen to the noise of the headlines or you can follow the smart money. And when it comes to commodities and currencies, it depends on the instrument. Canadian dollar over the next few years, I would want to be long, just as I'd want to be long the yen, Australian dollar, probably euro, definitely pound, and short the US dollar. Not because I'm some conspiracy petrodollar BS, just this stuff runs in cycles. So Rue Reynolds, Cooper Standard has $1 billion of debt, $100 million of interest expense. Debt's due starting 2026. In small amounts in 2026. Okay, so tell me something I don't know, Rue. Okay, so you're worried whether they have the cash to reinvest in the business. OEMs must be concerned. Now, the OEMs are the ones that helped them get out of the mess and helped them gave them the price concessions in order they could refinance. The OEMs need them to survive. We've covered this in past podcasts. Liquidity. Liquidity is not bleak. They've got $284 million of liquidity. So this is the type of question you get from someone who follows price and has an emotional reaction because the stock price is down 10 points from the peak. You know, we started buying this thing at 510 or whatever it was, 550. Well, we bought some at 6, we bought some at 4. And we think this is a good level to add, and we would put new clients in this thing right now, right here. We understand all that, but the biggest risk was taken off the table. The biggest risk we took was when the stock was at 5 and we didn't know if they were going to get refinanced. The reason we took the risk is if they couldn't get refinanced on their own, we could introduce them to private credit people that could potentially get it done, albeit not as good of terms as they got done. But the key is they could get it done. So when we look at the run rate of the cuts, what do they need to reinvest? I mean, they've already got the best rubber and the best all this stuff. I mean, yeah, there's certain CapEx that they have to tool up and everything else, but they work with the OEMs to do that. And I think time is on our side with this. But if you think differently, don't be in the stock. That's all I can tell you. I mean, we've covered this ad infinitum. Sam R., I'm watching Bloomberg and CNBC, and it's honestly quite sad that everyone has to care about what the Fed does every microsecond. Fed shouldn't even exist, but we have to play the game. All right, I don't see a question there. I don't really agree with that statement, but thank you for watching and listening and sending in your question. Lana X, and by the way, you don't have to pay attention to the Fed, and the Fed doesn't matter if you're thinking about ownership of businesses. If you buy 5 Jersey Mikes and, you know, each unit throws off $200,000 of free cash flow on $1 million of sales, what do you care if the Fed, if interest rates go up or down, unless you're leveraging them to the hilt? So the number one analysis we do when we enter any situation is solvency analysis. Once we've got that content and we've got enough time horizon that you can hit a window that comes every 1 or 2 years to refinance, then all you want to be focused on is how many sandwiches are they selling? How many generators are they selling? How many tools are they selling? How many chips are they selling? So the point is you don't have to pay attention to the Fed. If you know what you own and the underlying fundamentals of the business are doing great, all the noise about the Fed is just going to change the short-term price. And if you're not on leverage, you don't care as long as you know what you own. If you're just chasing price because you think you're a trader, well, thank you. I'm going to get your money sooner or later because you're going to give it all to me because you're going to sell in the hole and you're going to buy at the top. And I'm going to be selling to you when you want to buy, and I'm going to be buying to you when you want to sell. And that's just the way the game's worked since day one. That will never change. And that's how money's made in the business. And the vast majority of consensus will tell you otherwise. Chase the shiny objects, and then they get their heads chopped off. You never hear from them again. Their account goes dormant. Oh, whatever happened to that guy? Oh, yeah, he was in the last Momo cycle, and he's toast. And they don't write books about those people. But over and over, people decide to join the legions of those who have come before them and entered the land of the Momo. Lana Alexinko, thank you for your recommendations and show. Any update on PayPal? The stock is dropping. Announced buy now, pay later. What's your opinion? It's such a small part of their business. It's immaterial, but it's just another reason in the short-term voting machine to go down while cash flow goes up until the sentiment changes. And today it's up. You probably wouldn't have sent in this question. I'm not talking about you, Lana. I'm talking about people in general. And yeah, is Apple Pay making inroads into one aspect of their business? Of course they are. They've been doing that for 10 years, which is why the stock is traded as it's done. But the vast majority of their business is the Braintree and the others. You know, even when you look at Venmo, they're used for different applications in different ways. And the one thing that is sure is the fast checkout is unparalleled. They're going to start being able to charge up on that $500 billion of business that they do. Margins are going to expand. And everyone that was focused on some stupid announcement about buy now, pay later, which is just an afterthought of their business, because no one looks at the actual numbers to see that that is immaterial. And candidly, I hope they do less of that business, because that's a absolute train wreck when you get a little softness in the economy that I don't want to be involved in. So sold to you, Apple. You want to take buy now, pay later? Have at it. You can have all the low credit garbage that blows up during recessions, and we'll just focus on people who take Ubers and buy tickets at Ticketmaster and peer share Venmo payments to one another and all the new innovations that Alex Chris laid out at the beginning of the year. Dimitar Mihanziv, thank you for your eloquent, tireless commentary on stocks and all things connected. Two companies, Netgear, which seems to be close to negative enterprise, again, marginalized out of the market. They appear to have a moat, doing high-end Wi-Fi equipment for business. Not sure this will save them. Omeris, reorganizing after bankruptcy. Old people homes, people getting old. All right, let's take a look. Netgear. Haven't heard that name in a while. NTGR. All right, so they're going from negative cash flow to positive free cash flow. The revenues are falling off a cliff. Their margins are picking back up. Yeah, I mean, the key thing here, Dimitar, is going to be, let's take a look at their balance sheet here. Balance sheet looks okay. They really have to have a new growth driver. Otherwise, this thing is just kind of like a cigar butt. You may get a puff or two out of it, but so that's going to come down to listening to management. They'll have to do some type of deal or some type of new product that they're excited about. I don't like the direction that this thing is headed, to be honest with you. So for me, they're higher, better use. The exception to that rule would be, do they have some new growth driver that they're working on? And is it plausible? And if so, then it might be worth a look, but it doesn't look very promising. OPREA. ORPEA. Just as a general rule, because I've been doing this for a long time, I've not seen many people make money in senior housing in public markets. This one does look like it's turning around. Let's see what the balance sheet looks like these days. $5 billion of debt, 700 of cash, generating free cash flow. I think the key thing here is you got to figure out is this sustainable and why? What's changed from pre-bankruptcy to post-bankruptcy? The stock is trading like it has no value. Why is that? What kind of dilution was created during that process? Why is there any equity left? So that's a huge project. I think it's probably worth looking into. I don't love that business, so I'm not going to do the work, but I think it's a decent find. JT Investor would appreciate your thoughts on the new payment features announced at WWDC, PayPal's Venmo, blah, blah, blah. Just covered that. Paul Gertz, no change. We own the same amount of shares that we own. And if new money comes in, it will be a position for us. Paul Gertz wanted to get your opinion on Clorox. I think Clorox is fine. I think we covered this a couple weeks ago too. But it's had a big move recently. So it's like, all right, Clorox. I think for the long term, you're going to be fine owning this. There is an aspect of, the Kirklands of the world destroying these old legacy brands. I mean, their free cash flow has been down. Their revenue's holding on. If I recall, they got this young woman in to run the company. I was a little bit skeptical of her experience, but it seems like she's doing a decent job. I don't know it well enough. I have to get more confidence in her ability to run this, although it's a good enough business, like Buffett says, buy a business that's so good a ham sandwich could run it, because one day a ham sandwich will run it. I don't know if that's the case here. I think she might be a value add. I just don't know enough. You can see here revenues have been flat for a few years. Cash flow is volatile. But, Clorox is Clorox. I would just say that you're probably okay for the long term. Let's see if you get any money while you wait. The dividend should be pretty good on this. In which case, I would say, yeah, you could probably hold on to it. You'll get paid while you wait. And eventually, over 5 or 10 years, it'll work to new highs. There's higher and better uses of capital. So 3.46 dividend. I think this is a company also that grows their dividend over time. Probably okay, Paul, but higher and better uses for me. But I think in the scheme of dividend companies roaring back, dividend aristocrats, quality businesses, predictability, I like your thinking. Fernan Diaz, longtime listener, first time AMA questions. Well, welcome. Thanks, Fernan. Thanks for your continued support to everyone, by the way. If you're not a client, best way you can support me, ladies and gentlemen, recommend it to one friend or family member that that would benefit from this information. The bigger it grows, the more I'm going to be able to do it for non-clients moving forward. And also like and subscribe on the YouTube channel. I know a lot of you watch it embedded in hedgefundtips.com or you listen to it, but if you liking, subscribing to the YouTube channel and writing a comment trains YouTube's algorithm to show it to more people who are looking for information about investing in the stock market. So it's better than even recommending it to a friend. Going to the YouTube channel, like the video, subscribe to the channel, and then write a comment below. Let me see if I can show you how to do that, because not everyone knows. Let's see. So if you go to VideoCast here, you'll see it's embedded, and a lot of you watch it right here. But if you just click on this link up here, it takes you to the YouTube channel, Hedge Fund Tips, or you can just go to Hedge Fund Tips and go to YouTube and enter Hedge Fund Tips. You'll get the Hedge Fund Tips channel. So you would just, you could share it with your friend this way by clicking on share and just copy the link and send it to them. You can subscribe to the channel there. You can like the video by clicking that thumbs up, and then you can just write a comment below here, and I usually respond to all the comments, and that will help grow the channel. Cannot thank you enough for the fantastic content you put out each week. It's not only the most informative podcast out there, but your witty comments also make it the most entertaining by far. Well, thanks. I appreciate that. I find myself recommending your content to everyone that crosses my path. Thank you. This is a super listener here. I appreciate that very much, Fernand. I find myself, I wanted to ask you if you finally pulled the trigger on Dava. I know you were looking into a few weeks back. Stop talking about it lately. Germany. I'm not going to comment. You should always assume that we own everything. And it's funny. I've gone on TV stations and they say, I'll talk about a couple names. I'll be like, do you own that? I'll be like, why would you have me on to talk about something I don't own? Like, unless I'm taking risk with my own money, why would you ever allow me to talk about a stock? Like, it makes no sense. Like, I'm going to recommend someone else takes a look at a stock that I'm not even willing to take the risk myself. That makes zero sense. But anyway, I know why they do it, but Dava is not going to comment much on that one, other than to say that it will likely benefit from the recovery in Britain and the pound and their central bank starting to take action. So, you know, the difficulty of why this could never become an oversized position, let's just put it in those terms, is because it's very difficult to understand what their technology moat is and how it can't be breached, which is why Warren Buffett never invested in any technology companies until he invested in Apple. So this is cheap enough that you could probably be wrong about it and still make money. And if you're right about it, you'll make a lot of money. So I'm going to leave it there and you can read between the lines. So I'll just say it would never be a large position for us. Ben Costa, thoughts on Mountain Vale Resorts? This thing runs from time to time. I don't like that business. It's like owning Churchill Downs. It's not my type of business. So I'll leave it at that. Let's just see. Mountain Vale Resorts has a steady free cash flow, monopoly on high-end skiing, down 50% from all-time highs, growth through M&A. Thank you for all the hedge fund tips content you put out. Absolutely amazing. Such a huge fan. Can't thank you enough. You are young Charlie Munger. Oh, so I'm the cranky one? I thought I was the optimist. But thank you, Ben. I appreciate that. That's a super, super compliment. I wouldn't put myself in that category, but I aspire to become better every single day. And that's what I work on. Yeah, I just stay away from these. I understand what you're saying, that their portfolio can't be replicated, and that's probably true. I mean, the free cash flow has been flat for almost 10 years. Revenues are growing a little bit. I think you're okay here. I just think there are higher and better uses. I like your framework. I like the thinking, Ben, and I just think there are higher and better uses, but you'll probably make money with it, and I understand how you got there. Cole Kettering, wondering about how you size initial positions and add to them over time. I'd like to know how to balance buying down with not becoming overweight a particular stock. I understand it varies with each position. Thanks for everything. Cole, that super varies by companies. You know, I mean, a company that has expected value of 10x also has risk commensurate with that expectation, and therefore would probably start at a smaller size because there's probably some catalyst that needs to happen, like a refinancing or something else. So that's going to start smaller and become a much larger size of the portfolio than maybe many are comfortable with over time. Versus a company that's kind of a no-brainer, that's down 50%, but it's a durable business that's temporarily out of favor, either due to a small recession, industry recession, out of favor, cost of capital issue, Fed noise, whatever. And, you know, it's pretty damn sure double in a few years, maybe a triple. And something like that, you can lean in heavy because your risk is lower, but also your reward is lower. On balance, I think the simple answer is if your framework is solid and you apply it consistently across a number of names, we like to run a concentrated book of 8 to 12 businesses we've done all the ample work on. then you could just go n equals 10, and you're not going to be able to predict. Some of them double in less than a year, which creates a tax problem. That doesn't happen too often. And some take 5 years, and most of them are somewhere in between to get your doubles and triples. So if you go n equals 10 and don't try to predict which one's going to pop fastest, that probably will serve you well over time, and you kind of equal weight them. But then you have to adjust that equal weight relative to the risk. So it's a lot of words without saying much, but I hope you got the theme within it, and you'll just have to learn over time by doing. So with that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.